Let me ask you something that nobody in this space is answering honestly. XRP just recorded over $1 billion in net ETF inflows. Institutional buy volume is outpacing the sell side by more than 2 to 1. On-chain transactions on the XRP ledger are surging week over week. And yet, you're watching XRP trade sideways while Bitcoin gets all the headlines. Here's the question you should be asking. Where is all that buying pressure going? The answer to that question is not being explained to retail investors the way it should be. And once I show you what's actually happening underneath the surface, in the dark pools, in the OTC desks, in the escrow mechanics, you are going to look at this consolidation phase in a completely different way. Pull up a chair, because what I'm about to walk you through changes the entire picture. Welcome back. If you're new here, this channel is about one thing: cutting through the noise and reading the structure underneath the market. No hype, no price pumping, just the data, the mechanics, and the logic. Today we are going deep on the XRP supply situation, and specifically, why the quiet phase we're in right now may be the most important window this asset has ever had. Let's get into it. Here's the hard truth that most people watching XRP charts are missing. They're watching price. But the real story isn't in the price, it's in where the supply is going. Right now, institutional players like Franklin Templeton and other spot ETF issuers are not walking onto Coinbase and clicking buy. That's not how this works at scale. They are sourcing XRP through dark pools and over-the-counter desks. These are private, off-exchange liquidity venues where large blocks of XRP change hands without ever hitting public order books. This is why you can have $1.1 billion in net ETF inflows and barely see a price reaction. The buy pressure is being absorbed in shadow liquidity channels, completely invisible to the retail investor watching a candle chart. But here's what most people don't understand about those dark pools and OTC desks. They are not bottomless. They do not have an infinite supply of XRP sitting in reserve. These desks source from exchanges, from large holders, and from Ripple's own escrow releases. And every single month, Ripple releases 1 billion XRP from escrow, but the vast majority of that gets relocked immediately. The actual net new supply hitting the market from escrow is a fraction of what most people assume. So let's think about what happens when institutional demand continues to grow, which it will, because regulatory clarity is now a reality. But the OTC desks start running low on available supply. At that point, Franklin Templeton and every other ETF issuer has no choice. They have to turn to the public exchanges. And when trillion-dollar institutions turn to public exchanges, they cannot quietly accumulate. Every buy shows up. Every bid moves the price. The supply on those exchanges starts to disappear. That is the supply squeeze scenario. And based on the flow data we're seeing right now, that scenario is not a distant possibility. It is being set up in real time. Let's talk about the math, because this is where it gets hard to ignore. There are 100 billion XRP in total, fixed supply, no inflation, no mining. Of that, roughly 55 to 57 billion are in circulation. Exchange reserve data has been trending downward for months. Platforms like CryptoQuant track this in real time, and what the data is showing is that XRP sitting on exchanges is being quietly drained. Not in dramatic fashion, steadily, consistently. Now layer in what Flare just revealed. They are working to lock up approximately 5 billion XRP, just through one wallet integration with Zaman, which holds roughly 4 billion XRP alone, by the middle of 2026. That is nearly 10% of the entire circulating supply being pulled off the liquid market through a single staking integration. One integration, not the whole ecosystem. Now think about the broader picture. The cross-border payments market moves $150 trillion annually. The foreign exchange market turns over $7.5 trillion every single day. The Nostro and Vostro accounts that banks currently use to pre-fund international transactions have roughly $27 trillion locked in idle capital. Capital that earns nothing, moves slowly, and costs institutions billions in operational overhead every year. XRP and the XRP ledger exist specifically to replace that system, not as a speculative asset, as the actual rail. If XRP captures even a fraction of the liquidity efficiency play in cross-border settlement, let's say 1% of the daily Forex flow, you are talking about $75 billion moving through XRP rails daily. At current prices, that requires an enormous amount of tokens per transaction cycle. But here's what people miss. As the price of XRP rises, the utility actually improves. You need fewer tokens to bridge the same value. Higher price means lower slippage, lower transaction size, more efficiency. The institutions aren't afraid of a high XRP price. A high XRP price is the point. This isn't a prediction. It's a design requirement. The system was built to need a higher price. The math demands it. While retail investors are refreshing their portfolio apps and arguing about whether this pullback is the end of the cycle, ask yourself what the institutional players are actually doing. Bitrue, one of the larger XRP-focused exchanges, just published data showing a 212% spike in XRP spot purchase volumes. Their buy side is outpacing their sell side by more than 2 to 1. And they are forecasting what they're calling a potential supply squeeze in Q2 2026, specifically because institutional accumulation has been continuous since spot XRP ETFs launched, with positive inflows every single week, and negative outflow days numbering only 5 since inception. Franklin Templeton, one of the largest asset managers in the world. These are not people who gamble. They do not allocate client capital to speculative assets based on forum posts and YouTube videos. They position after legal certainty, after custodial infrastructure is in place, after compliance teams have signed off, and they are buying XRP. That signal alone should tell you something. You also have the Flare network building direct staking integrations with XRP ledger wallets, specifically to lock XRP into yield-bearing contracts without users ever touching a bridge. This is sophisticated infrastructure. Smart accounts, native staking pathways, deep integration with the XRP ledger architecture. This is not development theater. This is builders preparing for a world where XRP is not just held, but actively deployed. Locked. Off the market. Contributing to the supply squeeze in real time. And on the regulatory front, Indiana's HB 1042 just passed both legislative chambers and is awaiting a governor's signature. It opens crypto investment options for public retirement plans and protects individual digital asset activities. This is one of dozens of state-level moves happening simultaneously. The infrastructure of mainstream adoption, legal, custodial, legislative, is being bolted into place right now, while retail is distracted by red candles. The smart money is not panicking. The smart money is positioning. There is a significant difference. So what are the actual triggers we're watching in the near term? First, the market structure legislation currently moving through Congress. If market structure clarity gets passed, the last remaining legal ambiguity around digital assets in the United States essentially disappears. That is the final gate before institutional allocators who are still on the sidelines. Pension funds, sovereign wealth funds, insurance portfolios can begin formal allocation to XRP. The gate is almost open. Second, Ripple's banking license application. If approved, Ripple transitions from a payments technology company into a regulated financial institution. That reframes every conversation with every bank, every government, every central bank partner they're courting globally. The conversations change overnight. Third, Q2 2026. This is the window that Flare has publicly targeted for hitting 5 billion XRP staked. It's the window that Bitrue is forecasting for the supply squeeze. It's the quarter where multiple regulatory timelines converge. This is not a coincidence. The pieces are aligned. The window is not closing today. But it is closing. And the people who understand what's being built are not waiting for the green candles to confirm what the data is already showing. I want to be precise about something because I see a lot of confusion around this. The scarcity I'm describing is not a myth. It is an arithmetic outcome. Here are the numbers. 55 to 57 billion XRP circulating. Of that, a significant portion is already held long-term by wallets that have not moved in years. Exchange reserves are declining. Flare's staking infrastructure is locking up supply. ETF issuers are draining OTC desks, and 1 billion new XRP enters circulation per month from escrow, most of which gets relocked. At the current rate of institutional accumulation, the available float, the XRP that is actually liquid, tradable, and accessible on public markets, is contracting. Not dramatically, not overnight, but consistently, measurably, and in one direction. When the OTC desk can no longer fill institutional orders quietly, that liquidity has to come from somewhere. It comes from the public order books. And when trillion-dollar firms start competing with retail for the same limited supply on public exchanges, in real time, visibly, with the whole market watching, the price behavior will be unlike anything we've seen in previous cycles. You are watching the quiet phase of a supply compression. The signal is clear, but only for those who are actually looking. I know the counter-arguments because I hear them every day. XRP is centralized. David Schwartz, who architected the XRP ledger, has addressed this directly and repeatedly. The ledger was intentionally designed so that Ripple cannot control it. Ripple cannot freeze your XRP. Ripple cannot reverse transactions. The architecture reflects a deliberate choice to build something even Ripple itself cannot manipulate. The centralization narrative is 2018 FUD being recycled by people who haven't read the technical documentation. This is just the banker's coin. To which I would ask, when the largest banks in the world are actively onboarding into the digital asset space, when central banks are exploring digital settlement rails, when regulatory frameworks are being built specifically for institutional adoption, why would you not want to hold the asset that was purpose-built for exactly that use case? The banker's coin argument was meant as an insult. In 2026, it reads like a thesis. The objections haven't changed, but the evidence has. Here's what I want you to take from this analysis. Most retail investors are going to react to price. When XRP runs, they'll chase it. When it pulls back, they'll question everything. That is the cycle. That has always been the cycle. And by the time the green candles confirm what the data is already showing, most of them will be buying tops, not bottoms. You are watching this video right now, in the quiet phase, before the confirmation. That puts you in a very different category. The informed minority who understands what's being built does not need a breakout candle to understand the thesis. They understand the thesis. The candle is just the confirmation. There are, by some estimates, fewer than 300,000 wallets in the entire world holding more than 3,000 XRP. 300,000 people. On a planet of 8 billion. That is an extraordinarily small group. And most of them will sell long before this asset reaches its logical destination. Because humans are wired to take profits, not hold through discomfort. If you're still here, if you understand the supply mechanics, the institutional flows, the regulatory architecture, and the design requirements of a global settlement layer, you are already positioned ahead of the vast majority of market participants. Stay patient, stay rational. The math doesn't care about your emotions, and it doesn't care about red candles. It only cares about supply, demand, and time. In a market fueled by noise, we thrive on structure. I'll see you in the next one. Comment supply squeeze below if you made it to the end. I want to see who's actually paying attention.